What is the biggest challenge as you're looking at all the data inside to see where inflation's rearing its head and so forth? Is it wages and salaries? Is that one of the big components? Is it energy is generally is a component there, and food's a component, but sometimes you don't count that, you know. What is your biggest challenge in measuring, engaging, in configuring what inflation's doing or not doing?
So we look at many measures of inflation. Our objective, we recognize that food and energy are very important parts. Consumers spend a good share of their budgets on food and energy. We do not want to ignore movements in food and energy prices in measuring inflation. So in my testimony, I began by saying that an overall comprehensive measure of price increases that includes food and energy ran at 1.6% last year. There are many different measures. We've focused explicitly in saying that we have 2% inflation goal on the measure we regard as the best measure we have of consumer prices, which is the personal consumption expenditure price index. It's less well known than the CPI, but we think it's actually a more comprehensive measure. Now, food and energy prices are very volatile, and in looking forward over a number of years and trying to estimate where inflation is going, we often look at measures called core measures that remove food and energy prices. Wage developments, it's unclear that they have much direct effect on inflation, but generally what we've found is that in a situation where labor and product markets are tight, inflation tends to move up, and movements in wage growth gives us a sense of just how tight labor markets are.
In the area of regulations, last time you came before this committee that you alluded to, I believe it was back in June, I asked you the Federal Reserve's plans to tailor the CCAR process to provide much-needed relief to smaller regional banks. On January the 30th, the Federal Reserve issued its final CCAR rule, which tailored the process for institutions that have less than $250 billion in total consolidated assets and less than $75 billion of total non-bank assets. What is the significance of what you did there, and how will that help them?
I think that change will reduce burden substantially.
Regulation.
For a significant number of institutions. After engaging in a 5-year review of CCAR and our stress testing methodologies, we decided that the capital planning processes of those smaller institutions could be adequately reviewed and commented on through our normal supervisory processes, and that it was appropriate to exempt them from the qualitative portion of that capital review. But we still are subjecting them to our stress tests and requiring that they conduct stress tests themselves. That is an important component of our supervision.
But as a regulator, you will continue to monitor that, and if it needs to be tailored, you'll do it, whatever it takes.
Yes, we believe very strongly in tailoring to make sure that our regulations fit the risk profiles of particular institutions, and especially for smaller institutions, we're very well aware of the burdens that they face and are looking for every way we can find to mitigate those burdens.
Thank you. Senator Reid.
Well, thank you, Mr. Chairman, and thank you, Madam Chair, for your leadership. Some of my colleagues in the Congress have called on the Federal Reserve to use a formula, a very strict formula, in setting interest rates. Many times they refer to the Taylor rule. Could you explain to us how this would affect particularly working Americans? Would to be good or bad, and how do we explain its ramifications to our constituents?
Well, right now, the Taylor rule would call for a short-term interest rate somewhere between 3.5% and 4%, which is obviously a much higher value of the federal funds rate than the FOMC has deemed appropriate given the needs of the economy. I believe we would have a much weaker economy if in the last number of years we had followed the dictates of that rule. Unemployment would be substantially higher, the labor market would be weaker, and instead of inflation, which is running below 2%, and we want to see it move up to our 2% objective, I believe inflation would likely be lower than it is now.
So we'd see fewer jobs, higher mortgage interest rates, a weaker economy if we were essentially just automatically following a formula.
That's right. I recently, a few weeks ago, gave a speech at Stanford where I tried to explain why I thought it was appropriate to adjust the recommendations of rules like that to take into account, for example, the fact that not only the FOMC but most outside forecasters believe that the so-called neutral rate of interest has been unusually low in the aftermath of the crisis, and the Taylor rule would assume that it's at 2%. Current estimates would put that estimate closer to zero.
Thank you. There's another aspect that I've been working on for years, and particularly incorporated some of the language in the Dodd-Frank bill, is ensuring that clearing platforms are used, but there is a risk because systemic failure would be significant. So can you give us an update on what you are doing, your colleague, to ensure that these central clearing platforms are adequately protected from a failure, i.e. the consumer's ultimately protected from failure?
Well, we strongly believe that well-regulated and well-managed financial market infrastructures, and that would include central counterparties, play a positive financial stability role. They can help stem the propagation of disturbances, and they reduce the volume of transactions among key financial institutions. And we think they play a financial stability role, but they can also be sources of risk to the financial system if they're not themselves well managed. Title 8 of Dodd-Frank created a structure in which the Federal Reserve, the CFTC, and the SEC have oversight responsibilities to make sure that these key infrastructures of our financial system are managing their own risks successfully. And we're cooperating with the other regulators in our examinations to make sure that appropriate risk management standards are in place.
Thank you. A final question in that. Cyber security is the issue on everyone's mind, and you recently have advanced notice of proposed rulemaking which would require a board of directors to have adequate expertise. I've been involved with legislation that would apply not just to financial institutions, but a publicly held company, because the cyber threat is not limited, it is ubiquitous. Could you just briefly, very briefly, give us your sense of how important it is to get this cybersecurity expertise